Welcome to Option Trades Today. I'm Tony the Bat Batista. I'm going to try to find you a trade in this very low implied volatility environment that we have in the market today. Let's take a look at what's going on. Even the S&Ps, after trading up to 4,068 earlier this morning, sold off about 20 handles. They're still up around 8 or 9. I think the bull market looks intact here. Now, when I'm looking for new trades, you know I like to go into the high option volume. You know I like to go into the high, look into the IV rank, put that from the highest to the lowest by just clicking on the ranks. And when you look here, you can see that there's not a very high implied volatility in any products that we are interested in trading, at least that I can see from here. I'm going to push it up here for you real quick. I'm so sorry. There you go. ATVI, it has earnings on the 6th. The only stock that doesn't have earnings here is FFIE, which is an 80-cent stock. I'm not interested in that. All of these have earnings. Again, I'm wanting to avoid earnings. BBY, I'm not interested. $3 stock. UNG, we already put a trade on there. Had a nice profit in there over the last couple of days. Didn't take it. Today, the stock is a little bit lower. I think we're about even from my podcast in UNG when we did a Jade Lizard. But it does meet the criteria of high IV rank, no earnings. Again, a very low price stock. I'm not going to go through all of these, but I'm going to tell you what I am going to do. I'm going to go into a post-earnings trade. That means the stock has already had earnings. I'm going to go into Netflix. Now, you're going to look here and see the IV rank is under 0, or was just a moment ago, it was 0.5. Now it's under 0. That means implied volatility continues to collapse, even when /VX is showing some strength in volatility, maybe leading to a little bit of market weakness. And you can see we have a little bit of a mixed bag of tricks here with the Dow lower, Russell lower, NASDAQ higher, and the E-mini S&Ps higher. Well, I'm going to go into Netflix, and I'm going to look for a trade, and I'm going to try to use all of the different criteria that we've had on our shows here. Now, I'm going to go to March, because March has 50 days. February has 22 days. We're usually looking to roll trades from 1 month to the next when you've got around 21 days. That would be tomorrow. So it'd be silly for you to put a trade on in Netflix in February thinking that you're already going to be rolling in a day or two. So I'm going to go to March. I'm going to stick with my selling of premium strategy, even though the implied volatility is extremely low. So how can I do that? 1, I've got to reduce my size. And 2, I've got to come up with a different strategy. I don't want to sell a strangle in here because I don't have that embedded, what I feel is that embedded edge of implied volatility contracting after it's expanded. Remember, volatility is more mean reverting than price of the stock. So what am I going to do in here? I'm going to do something with some directional bias. Now, I'll show you the trade I did, and we'll compare it to a trade that's very, very similar, and you can decide what you want to do. First of all, you have to come up with an assumption in Netflix. Me being a contrarian, I know the stock is already down $4.70 today, but I'm saying enough is enough for Netflix right now, even though it does have a correlation to the overall market of 0.64, which means it's fairly correlated to the overall market. That means I'd have to be a little bit bearish in the overall market or slightly bearish. And I do feel that for the short term, we're a little overbought, but who knows there. Netflix, on the other hand, to me, looks like enough is enough to the upside. So I'm going to play it with a short bias. Now, you can do the same thing on the put side that I'm going to do to the call side if you're bullish on Netflix. Again, this podcast is all about giving you food for thought, ways that I look at things, and then you make it your own. So I'm going to look to reduce my size. That's paramount. And I'm also going to find a strategy that doesn't use a lot of buying power. So what am I going to go to do? I'm going to go in, I'm going to do a very tight butterfly, not a regular butterfly, but a broken wing butterfly. I've done a lot of these on the podcast. I usually like to collect around $1 on any type of trade I do. Now, again, low implied volatility, defined risk trade mitigates some of that implied volatility expansion and contraction that you would see in the market. So I'm buying one of the 390 calls. I'm selling 2 of the 395 calls. I'm going, if I'm $5 wide, I'm going to go $10 wide. That's risking 2 to make 1. I traded this spread up at $1 earlier today. I will show you that in a moment too. When the stock is trading right around here, so I think you'll be able to get filled too. You can see the markets are a little bit wider here. 75 cents is the natural bid. Natural offer is $1.25. You probably get filled $1.01 with the stock down $4.70. Now, let's look at this trade first before I show you something else. Probably profit, write that down, 76%. I'm going to show you something else in a moment that's going to have the same type of probability of success. Delta is around 3, short around 3 overall deltas. The beta-weighted delta, short around 3 also. So this does have a high beta weighting to the S&P. My theta decay is small relative at $1.25, but my buying power effect is only $400. Now, why is it only $400? Well, that's because my risk or my break even on this trade, remember, if the stock were to go to 400, we'd be long the 390, 395 call spread one time, and we'd be synthetically short the 95, 405 call spread one time. That spread that could go up to $10 would only be worth $5. I'm long a spread at $5, but I did it for $1 credit, so that gives me $6 in total. That means my break even is $401. I'm using $400 worth of buying power. Now, why use 3 legs instead of just using 2, which you certainly can? Let's take a look here. Let's look at, since we're synthetically short, or synthetically our break even is $401. What if we just sold the 400, 405 call spread? Now I can get a couple pennies more. I can get $10 or $15 more. I'm using the same amount of buying power, just about $400. Obviously, the difference is $15 by that extra credit that I just received on this spread. Why would I do this spread, which has the same type of delta 3, has the same kind of beta weighted delta 3, but a probability of probably a profit of 76%, all the same? Why do the 3 legs versus just doing this 2-legged spread? A little simpler, $1 less or so in commissions. Why do the other spread over this one? Well, I'll tell you. For me, since it's going to be a trade where I can't really adjust it. I mean, yeah, you could sell a put spread on the other side if you get too tested to the upside. I could also sell a put spread on my spread that I did. Really, why do I do the 3 legs over the 2? Because I have a chance to make $500 over making just $1 and change that I had on the other spread. So again, 390, 395, selling 2 of the 395s, buying 1 of the 405s. I did it for around $1. I have the chance at making $500. Again, this is a trade where you're probably going to set it and forget it. There's not too much adjustment to it. So what I've done with low implied volatility is I've come up with a strategy that has a limited amount of delta, a limited amount of risk, $400, really no management to it. And I'm just going to say to myself, all right, look, I'm going to keep this in through expiration for the next 3 weeks or so, till there's around 21 days, or maybe close it when I've made 50 cents or 75 cents on my $4 worth of risk. I told you I would show you where you can find this trade. Again, you can go into the follow page. You can click on Bob the Trader, where my picture is. You'll see Netflix right up here, and you'll see that I put in post-earnings, low volatility trade, because that's exactly what this is, and I got filled at $1. Now, if you're looking for any type of adjustments on any of the trades, here's my Tesla roll from earlier today, bringing a position in that I've had on for quite a few months. A lot of rolls being done in Tesla, a lot of different trades in Tesla. If you've been watching these or you want to watch them, you can just put Tesla in there, and then on the Tastyworks platform, all of my adjustments will be up there. Everything I do, everything I say in real time will be up there for you to see. All right, everybody, please do me a favor. Open an account, move account, transfer an account to Tastyworks. That's where I just showed you where all of my adjustments are. And and one other thing, I read the comments. People always ask, why is my buying power different from somebody else's? My buying power is no different than anybody else's. I'm using a regular margin account here. If you're trading in an IRA account, like here, the buying power is $5,000. If you were doing this trade in an IRA account. Now, remember, Tastyworks is one of the only brokerage firms that allows you to sell naked calls in an IRA account, but it allows you to do it. Other brokerage firms don't. But if you're putting a spread on like this, it might use 10 times as much buying power. It might use $30, $40, or $50,000 worth of buying power. That's just because you're in an IRA account. You're not in a margin account. I'm in a margin account. Please move all of your accounts to tastyworks.com and help us keep the lights on here.